Hello and welcome to our first Honey Market AMA. If you haven't signed up to Honey for our daily take on the markets, be sure to do so through the link below. Now, the long-awaited reopening trade put a spring in the step of UK shares pretty much since the end of January. But July has been a different beast, and that optimism has crumbled quite a bit over the past few weeks. We're here to answer your questions on all of that and more. And remember, to get your questions at the front of the queue, keep referring your market-loving friends to Honey. And it's 5 referrals, remember, and you get to ask us whatever question you like, as long as it's related to the markets. So I'm here, my name is David Kimberley. I'm part of the editorial team here at Freetrade. I'm joined with Dan Lane, our senior analyst, who's gonna be helping me answer your questions. So to get started, we have a question from Fadi, and Fadi asks, Freedom Day early this month brought big market falls on both sides of the Atlantic. How much should we read into that? So Dan, how much should we read into that?
Yeah, hiya, David. Yeah, do you know, it's a really good question. We all thought that the markets would explode really whenever the economies got back to pumping. But, a lot of the times, in markets, traveling is better arriving. The journey kind of is a little bit more exciting, breeds a little bit more momentum than the actual destination. That might be what's happening here. And especially now that, these Delta variant fears have come back into play. We've all been excited. We're getting into the pubs. A lot of us who've not really enjoyed wearing masks can have a little bit more of a lenient attitude to that. But there is this variant that's having people a little bit trepidatious going out there again. But it's also a fear on the economy. A lot of the companies that have been waiting to reopen are just a little bit scared as well, because what if they open and then have to reclose immediately? On the other side of that, there's a completely different thing. We have to worry about inflation. We've been hearing a lot that inflation is transitory. That seems to be the word on everybody's lips. Most of all, the Fed in the US. Inflation sitting at 5.2% in the US, 2.5% in the UK. Now, that's okay, I guess. The markets aren't going to react too heavily to that if it is transitory and if it is fleeting. But given that it's coming around, there's a few readings coming one after the other that are looking to stay around a little bit. It seems to be less transitory than first thought. High inflation could provoke a rise in interest rates. And that's really, we're seeing what's happening there in the US, where the US tech high flyers are people are feeling they're a little bit more on shaky ground. One thing that's happening is that some investors are moving to the UK, because the UK's coming into July, the UK was the lowest valuation. It was amongst major global markets. It was trading on something like 13 times earnings. The US was like 23. So very cheap. The UK was very cheap. Doesn't necessarily signal great value, just means it's cheap. But there are legacy sectors like mining and banking that everyone was, all UK investors really wanted us to have a tech high flyer during the pandemic, and we didn't really have it. Now they look a little bit vulnerable, and people are starting to think, oh, well, it's not too bad. We have legacy sectors that might look attractive amidst like an economic reopening or a higher inflation world.
Yeah, I think those are some good points. I would add that one of the things I've been banging the drum about a lot over the past 18 months is there's just so much hype, I think, in certain sectors, particularly in the US. You have sort of green energy, tech, renewables of some description, electric vehicles, all that kind of stuff. And I think that's maybe made people forget that there's still lots of good companies that do slightly boring things. So if you look in the UK, I've mentioned in this week's Honey, Schroders, Barrett Developments, so financial services business, home building business, not the most exciting in the world, but they've performed perfectly well over the past couple of years. That's not to say everyone should rush in and start buying them, but just to make you think that not all investing has to be some kind of novel technology or something that's going to be really groundbreaking. There's still lots of great companies that do the sort of more mundane day-to-day things that we use in our daily lives. So anyway, let's move on to the next question, which is from Callum, which is a slightly different one. Callum asks, what's a good way to invest in commodities? So a slightly different one there.
Yeah, a different one, but probably brought on by this speak of inflation. These raw materials companies can raise their prices in line with inflation. That's what a lot of the textbooks tell us. Yeah, listen, at this point, it's probably good to say, you mentioned a couple of companies there. This isn't a stock pitching session. This is just going over what the market's telling us and maybe a little bit of an outlook, but none of it is financial advice. And, we aren't advisors. Certainly I'm not, and I know you're not. We just love talking about the markets and love going over them. If anyone's unsure about their financial situation, definitely speak to an advisor. But yeah, what we were just talking about is just a wrap up. So it's not an inducement to buy or sell anything. There we go. I think I've filled the compliance box there. But in terms of commodities themselves, you've really got a gamut here, and they've been out of favor for a little while. We saw them come back in 2020 in Q4 with gold, and actually gold hit a record high last year. So people are starting to switch back to them. They kind of went out of vogue again because tech came back. But what are the options? Okay, well, we've got the commodities themselves. So you can buy your gold, your silver, your palladium, your nickel, your lithium. You can buy all of these things. If you have a nice little vault at home, you could trundle home with a gold bar and put it in there. Or if you don't fancy doing that, you've got these ETFs that track like the spot prices. You've even got ETFs that have baskets of commodities, so things like core commodity. That's one of the ETFs on Freetrade. So that's just an easy way into the sector if you need to have some commodity exposure. Then you've got things like investment trusts, like BlackRock World Mining, Evie Hambro's fund. So they will go in and pick kind of miners, these commodity miners, and hold the actual company shares themselves. One of the positives of that structure is that sometimes they go for commodity stocks who fund mines, don't actually own the mine, but then what they do is they get a royalty stream from any profits that mine makes. It's a bit like music royalties, but you're not getting chart-topping hits, you're maybe getting gold out of the ground. So that's just one thing that sometimes investment trusts target as well as diversification. You're still in the mining sector, but the diversification probably comes from different stages of development within these miners. Some are mature, some are young. So yeah, it's not the same diversification you're going to get with kind of a broad market ETF. And then one that I'm hesitant to add because it does carry a little bit more risk are these AIM miners. So you kind of get these junior miners on the UK's junior market. They work from a small base. They have fixed costs, but once they cover those fixed costs, everything else turns into profit. So if you're getting a commodity out of the ground and you cover your costs, that everything else is profit. And if you're a small operation, that can mean quite a bit. But with that comes the possibility that these explorers or miners never actually find the asset or spend so long finding the asset that it eats into the capital of the company. And they garner this really unfriendly name, this lifestyle companies. And these are companies who kind of continually dilute the share price, continuously raise capital to pay salaries and pay ground rent for these mines, and then they never actually make it. So there's a huge amount of risk there. But they're just some of the ways that you can really get into commodities.
Okay, I think you've done quite a comprehensive job there, so I won't add anything to what you said. And we'll move on to the next question, which I think is very pertinent to you because if anyone watching is unaware, Dan appears most weeks on the Vox Markets podcast with Justin Waite. He's Freetrade's representative there to talk about UK small caps. So that's smaller stocks trading on the UK markets. And we have a question from Sabrina, which is, what's the outlook for UK small caps at the moment?
Yeah, I mean, good question. And, there's such a wide range of small caps. It's hard to say what is the outlook. I guess, where do we start? Okay, well, if we look at the FTSE 100, these huge international companies that are listed in London, around 75% of their revenue streams actually comes from abroad. These are truly international businesses. Move down to the FTSE 250. It's closer to 50-50. It's not quite, but it's maybe 50% revenues from abroad, 50% from at home. You actually wrote a great piece on this and the divide and how you can kind of think about the domestic economy and who's being represented there. So as you go down the cap scale, you get more closer and closer to serving the domestic economy. kind of makes sense if you think about it, because smaller companies don't have a global reach. They're more likely to serve their immediate community. And that's where it is on AIM in the small caps. So what you then say is, okay, well, if they're serving the domestic economy, they're probably more tied to the fates of what the UK is going to do as an economy and how it comes out of this pandemic. So if we look at the OECD figures, they're saying that the UK economy is forecast to grow by just over 7%, 7.2% in 2021. Now, that would give it the fastest growth in 80 years. We have to accept that that's on the back of a particularly awful year. So, pinch of salt and everything. But relatively speaking, I'm just looking at some figures here. US is due to grow at 6.9%, Eurozone 4.3%. So it's not nailed on, but given the opportunity set for the domestic economy to grow as we all get back out and support it, the firm directly tied to the domestic economy or more tied to it, it could be quite an exciting time for small caps. But yeah, that's not to say that it's a sure thing, or small caps can have wildly different markets and influences and bank balance sheets. We recently did a piece on AIM and how to really get into AIM and not get your fingers burnt, looking at their levels of debt after the past year, and which has been very hard to survive. That's going to be hugely important for all investors in small caps.
Yeah, I mean, I suppose one point I'd add to that, which is another word of caution, which is I think that a lot of the time when you talk about a particular macro trend being positive for company X, it seems like people then rush into buying any company that might stand to benefit from it, and then ignore the nuances of that individual company. So even if the economy does grow or improve in the UK, that's not to say that just because you're serving the UK economy that you're going to do well. So just be sure to make sure that it's actually a good company, not a rubbish one, because macro trends don't guarantee that you're going to benefit from them. And next question is away from the UK and talking about China. So Louis asks, has China pretty much killed off crypto or killed off the crypto rally?
There we are. Short and sweet from Louis. Thanks for that. Yeah. Do crypto? It's fun. And just before we start there, crypto is something that maybe 5-6 years ago we would never have talked about. We wouldn't given kind of air to it as a proper asset, and we're having to do that now. It's something that it's grown so much, and there's so much money in it now that we have to kind of look at it. That said, it's still a fledgling area of the market. It's still a fledgling sector. Anyone who tells me that they know anything about the valuations of these things, I mean, I'm just either going to have to defer to them or else, ask them to explain a little bit more to me, because I just don't think that you can properly value these as assets. Now, that doesn't mean that crypto is useless. It doesn't mean that, ultimately this is the last we'll see of, any type of Bitcoin variant or altcoin or anything. What recent events have shown us is that they aren't untouchable. The Bitcoin and all its pals were meant to be kind of this decentralized currency that was meant to be the alternative to getting stuck in kind of federal Reserve or kind of Bank of England, Bank of Japan, anything like that was meant to be. It wasn't meant to be affected by any of these central banks. What we've seen is that that's not true, is because China has really clamped down on it. I've seen videos and videos about all these mining machines being destroyed. I actually saw one in Malaysia about these steamrollers going over all these mining machines. So, in the East, they kind of know what they're talking about here. They're not behind the door and coming forward and doing what they practicing what they preach. It's not the end of crypto, I don't think. I think Bitcoin is on shaky ground, and because Bitcoin is the poster child of it all, this is what's bringing the crypto market down. Whether Bitcoin will be the poster child for crypto in 5 years, I don't know. But what we're seeing is a lot of use cases spring up with other coins and other variants of crypto. So if I look at just an example here, would be Telcoin, which is its plans to be a competitor to Western Union in the remittance service. Now, it plans to take full advantage of a banking license. It's a compliance first operation. They want to get on the regulator's good side. This feels very, very different from the crypto 5-6 years ago, which was very much pretty much a 2 fingers up to the establishment. We're not going to play by your rules. We're going to create our own currencies here. What we're seeing now is a little bit more of a maturity to the market. So sorry, a bit of a long-winded answer. Maybe Bitcoin is on shaky ground. I don't think crypto is. And that's maybe where I'll leave that before I get in trouble.
Yeah, I mean, I've had I would add a couple of things. The first is that I think people for a long time people haven't really figured out exactly what they want Bitcoin to be. For a lot of people, it seems to just be this YOLO speculative thing where they think they can get rich quick from it, and then for other people, it's just supposed to be some kind of hedge against inflation. Then for others, it's supposed to be an actual currency. I think that on the latter point, it's really hard to find a good example of it being used as a currency, just because it's really hard to price anything. If you imagine if you're a landlord and you get paid in Bitcoin, you can't guarantee that next month it won't be worth half what it is the previous month. And I think also for inflation, there seems to, I wrote about this a while ago and got some hate mail, unsurprisingly, in response, saying that Bitcoin may not actually be a great hedge against inflation. And I think people are confusing the fact that it has risen more than inflation has, with it being tied to inflation. The two don't really seem to match up. I mean, Bitcoin has fallen in years when inflation has risen, and has risen exponentially more than inflation has risen at other times. So that's something I would be careful of, and I would be careful of the sector in general. But that's my
Yeah, I mean,
job
listen,
to say that.
just because an asset rises this as the same time as inflation doesn't mean that it's a hedge necessarily. And the fact is that crypto just hasn't been around long enough for us to draw clear conclusions. We could slip into confirmation bias and just look for what we want to see and look for the characteristics that we want it to have. But that's just not prudent. We have to be a little bit more mature. It might be there, it might not, but we have to give it time.
Yeah, I think that's a good idea. So the last question we've got this week is from Francesca, who asks, I've got an ISA and a SIP with Freetrade. Should I treat them differently in terms of the assets I put in them?
Well, Francesca, she gets extra points for having her ISA and SIP with Freetrade. I would say, look, I like this question, actually. It's coming away from assets, and this is more about financial well-being, isn't it? And using your tax-efficient accounts properly. Listen, whether you have an ISA or a SIP, they're just the wrappers, okay? If you've never heard them being described as wrappers, it's because you decide what goes in them. And it's not just there for you, especially with investment products. So take a step away from the market for a second. Think about your goals. Think about your time horizon. Think about your attitude to risk. And then let that inform the assets. And you won't go wrong in terms of what you pick, the suitability of the asset. I'm not saying about performance, obviously that can vary, but there's a range of assets that you would say maybe would be more suitable for low risk or medium or high risk investors. But if we start with this kind of triumvirate or this triangle of goals, horizon, and risk, if you look at your SIP, you'll naturally have a longer time horizon, hopefully. You can access your SIP from 55. It's going to rise till the age of 57. Not sure what age Francesca is, but that might be a longer term investment than an ISA. And we tend to find that allows you to take a little bit higher risk, because the trajectory of that is more likely to smooth out over the long term. I always think about, looking at Earth from space, or looking at a golf ball. It looks quite rigid and like bumpy up front, but take yourself away from it, starts to look a lot smoother. But that doesn't mean that the assets that you take should be just a punt. The risk in that sense doesn't just mean the next hot stock and I'll just leave it for 50 years. That's not what that means. It means that you should allow yourself to feel less pressurized during the volatility in that period. Equities carry a higher risk naturally than the likes of bonds. So you might feel more comfortable adopting equity risk over the long term because it's more likely to level out and give you the opportunity to beat cash over the long term. Think about ISAs then, the opposite way. They're more likely to be shorter term. We always say 5 years minimum is a good way to invest. But people will often use things like ISAs to hit things, things like house deposits. And that brings in a different element in the shorter term. There is a growth element to that. You want to get as much money as you can to pay for that house deposit. But then there's also a conservation element as you get closer to paying for it. And that might mean taking some risk off the table and mixing your assets, maybe equity heavy, to reducing that equity exposure the closer you get to your goals. That might mean more fixed income products. That might mean a slightly higher percentage in cash. It might mean going from a growth heavy equity to maybe something like equity income. We actually have a lot of that on the site, freetrade.io, on the Learn Hub, and then Use Hub. So Francesca, I would say it's a fantastic question. Definitely look into your asset mix there and have a look on the Freetrade site.
Great. Well, I think that's again another comprehensive answer that I won't add anything to. It's also our last question for the week. So just a reminder to refer your friends to Honey if you want to ask a question. 5 referrals gets you onto the AMA list, and we'll do these fairly regularly to make sure we are answering all of those questions. And I'll say, goodbye from me. And thanks, Dan, for answering those questions so well.
Thanks very much, David. That was really fun. Yeah, let's do it again.